discussions in this show should not be construed as specific recommendations or investment advice. Always consult with your investment professional before making important investment decisions. Securities offered through Cambridge Investment Research, Inc., a registered broker-dealer, member FINRA SIPC. Fixed insurance is offered through various independent insurance companies. Cambridge does not offer tax or legal advice.
Welcome to the SA Update, your go-to for insightful conversations and timely topics to empower clients and communities with financial confidence. I'm your host, Mike Schuster. Today, my guest is James Casler from Lord Abbett. James, welcome to the podcast.
Thank you very much for having me. I'm very excited to be here.
Yeah, James, we've worked with you, actually going all the way back to Fritz Anderson and I. We've worked with you since the firm has been founded and beyond in our past jobs. So tell the viewers a little bit about yourself.
Absolutely. Well, thank you for having me. Yes, we have an easy way of saying we're old. We've known each other for a while. I have been in the industry since 2004 and have worked for Lord Abbett since, I think 2014. So I'm working on 11 years, almost 11 years at Lord Abbett, and couldn't be more excited to be here today and talk a little bit about the capital markets and everything going on out there.
Yeah. And James, I know you have to read a little advertisement for the attorneys out there first. So
I do. I just need to say that as of this recording, the views and any opinions expressed today are mine and my own and don't necessarily represent everybody at Lord Abbett or Lord Abbett as a whole, and just intended to provide general investment education and is not intended to be individual legal, tax, or investment advice. And as we all know in the capital markets, all investments could potentially go down and have a loss of capital risk. So, thank you for letting me get that out of the way.
No problem. We always get the advertisement out. Well, today, James, and I appreciate your willingness to come on and do this, because our goal is to basically have timely conversations about things. And right now, interest rates seem to be one of the biggest conversations. And I wanted to start today with why the 10-year Treasury rate matters and talk a little bit about that.
So, rates in general, even though in theory, we think they should be very, very simple, right? A rate is a rate. They are not. And there are a lot of different drivers and factors that go into what drive short-term rates or, specific to your question, longer-term rates, the 10-year Treasury rate up or down, right? So when talking about rates, the most obvious relationship is the mortgage market, because the vast majority of people want to own a home or own a home. The quote unquote American dream. And long-term Treasury rates, i.e. the 10-year Treasury, are tied to the mortgage rate that you could potentially get when you go to a bank to get a 15 or 30-year mortgage.
Right.
So when the 10-year Treasury rate is higher and you want to buy a home or you want to refinance your home or you want to get a loan of a longer term, the interest rate you're going to pay the bank is going to be higher as well.
Right.
So the essential reason why does the 10-year Treasury matter, or why do rates matter, is because that's the lending rate that we as the investing public kind of move off of when we go to get a loan from a bank. So when they're lower, we like it. When they're higher, it's frustrating.
And so right now, a lot of the controversy we see out there is we see, the White House calling for them to lower rates.
Right.
Talk about, what really brings the rates down and that 10-year Treasury down.
So, and I'm going to date myself, but if we go back to, college, maybe Econ 201, right? And I'm going to try and keep this as simple as possible. The 10-year Treasury rate oftentimes is very, very close to the economic growth of our country, plus the inflation rate of our country. So if I were to keep it as simple as possible, if our economy is annualizing a growth rate, GDP is growing at maybe 2%, and the inflation rate of our country is 2%, you would expect the 10-year Treasury to trade, or longer-term Treasury rates, not just the 10-year, there's other Treasury rates as well, around 4, plus or minus. There's always wiggle room. There's always, kind of a band that it trades in. So right now, when you see, the 10-year Treasury, just roughly speaking, as of the date of this recording, somewhere in the mid to, 430, 440 range, that would insinuate that our economy sees inflation settling in, in the twos, and maybe the growth rate of our country in the twos. That's not a bad thing. When our economy grows, the capital markets grow. A little bit of inflation is not a bad thing as well, because that helps our economy grow. What we don't like is when we have a lot of inflation.
That's true.
Right.
And it costs more money, yes.
Right.
So talk about a little bit about the other side of bonds. We've been talking about borrowing costs.
Yes.
Let's talk about why people own bonds.
Absolutely. I mean, bonds are in a lot of ways, the ballast to a portfolio. Just to kind of level set, what is a bond? A bond is a loan for a certain period of time to a municipality, a government, a corporation, a variety of other topics. And in exchange for that loan, you receive interest. And then at the end of that set term, you get your money back. So if we were to keep it as simple as possible, bonds can only do two things: pay you your interest and give you your money back at the end of that term, or not. A word we don't like to hear: default. And we haven't heard that word a lot, specifically recently. And that's a positive thing. And that's why bonds, essentially are working right now.
Very much so. And I guess the other thing that everybody keeps talking about too right now is, when it comes to interest rates out there right now, what do you see specifically that will push rates down? Is it the economy getting hotter? Is it the economy getting colder? What is it? It's not truly the chairman.
That is fair. Yes, it is not truly the Fed, the Federal Reserve, if you will. They get a lot of publicity, and they are very important. I'm not discounting that, but the Federal Reserve can only control what we call the front end of the curve.
Right.
They only control short-term rates by moving. You hear about the meetings 8 times a year, and when the chairman testifies or has to speak at whatever engagements, that they talk about the overnight rate. That is a very, very short-term rate that the Fed can directly impact. Yes, it does move long-term rates when they make decisions, but longer-term rates are generally more impacted by economic growth and inflation than they are the Federal Reserve. So when the Fed makes a decision up or down, that moves short-term rates, short-term lending rates. The economy, in our opinion, and inflation will dictate the longer-term part of the curve.
And the last question I'll ask, because this is getting a lot of attention also, is what effect does government debt have on interest rates?
So it definitely has an impact on us as taxpayers, right? Because that's how we pay that interest. And just like us as consumers don't like having a high interest rate on our mortgage or on, a line of credit that we have or anything like that, the federal government doesn't want a high rate on their debt either.
Right.
So I understand that premise, but in a lot of ways, government spending, certain types of government spending, not all government spending, but a lot of government spending can be inflationary. And when inflation is elevated, that makes longer term rates stay up higher, not go lower. So that's why there's a balance. There's a fine line, kind of a needle that needs to get threaded by the Federal Reserve, and they have a very, very difficult job of, kind of when Congress passes a big spending package, how are they going to finance it, knowing that it could, it could create more inflation over the longer term? What is the economic impact of the spending package that just went through? Because that might actually make, even though short-term rates might fall, might make longer-term rates increase.
Overall, deficit spending is bad, correct?
The government
for the most part.
For the most part, yes. The government should absolutely spend money. Right. But should the government spend at a percentage of our gross domestic, our GDP that they are right now? Probably not.
Yeah.
In my opinion.
Which could, of course, be affecting the interest rate. Well, James, thank you for coming on today. We really appreciate it. We use Lord Abbett across multiple platforms here at Schuster Anderson, so some of you may already see that out there. And again, thank you for tuning in today.
Discussions in this show should not be construed as specific recommendations or investment advice. Always consult with your investment professional before making important investment decisions. Securities offered through Cambridge Investment Research, Inc., a registered broker-dealer, member FINRA SIPC. Fixed insurance is offered through various independent insurance companies. Cambridge does not offer tax or legal advice.